Lesson 5, what to buy. So you've opened up your stock accounts, you've funded your stock accounts, now you're ready to buy. You're like a little kid in a candy shop. But hold it, we got to start with the basics. I'm sure all of you, most of you, some of you have heard of mutual funds. If you haven't, that's okay. It's just a big grouping of stocks under one fund. The thing is, a mutual fund is becoming slowly a thing of the past, and a new, more efficient investment vehicle is now here to stay. It's known as an ETF, an exchange-traded fund. Don't freak out, it's nothing crazy. It's just like a mutual fund, but it's more efficient, and I'll tell you why. Usually with an ETF, the funds are cheaper, so that's fantastic. But what's even better is, what do we say? You can't buy or sell something in the market unless the market is open. Well, this is where it kind of gets tricky. With a mutual fund, you need to wait until the end of the stock market day after the close for the mutual fund price to settle. You cannot buy or sell mutual funds during the market day, but an ETF, you can, and there are usually also less fees. We want less fees when we're investing in any kind of vehicle.
Doesn't the giant normally say fee 555?
I guess he decided to get rid of fees.
The beauty of something like a mutual fund or an ETF is it allows you to diversify, and you can invest in tens to hundreds of stocks under one blanket investment. But people used to invest heavily in mutual funds because they were actively managed. Some kind of hedge fund owner would run that fund for you, and you felt that that allowed you to have some kind of edge in the market. Well, here's the truth. Only 4%, that's right, 4% of actively managed mutual funds outperform the market. 4%. You're paying a premium for that. Why not just invest in an ETF that follows the index? It's perfect. You have less fees, you will keep up with the stock market as a whole, and it won't stress you out. That's why I've been telling you that index investing through an ETF is the way to go. So just a little tidbit, there is a reason, there is a method to my madness as to why I'm trying to guide you more towards the index fund route rather than an individual equity or stock or company. I'll give you a perfect example. I'm invested in the cybersecurity space. I feel like it is a space that is going to continue to grow, especially in the current technological environment that we live in. I invest in an ETF called Hack. Say tomorrow there's a big cybersecurity company reporting earnings. It tanks. Everyone expected them to do great, but it tanks. So that stock falls 10% the following morning. So if I'm just invested in that one company, I've lost 10% of my investment. Instead, I'm in an ETF, and that ETF is comprised of 20, 30, 40, 50 cybersecurity firms. So when that specific company stock falls 10% the following morning, I lose 0.5%, maybe 1%, maybe 2%. The point is when you invest in an ETF based on an index or a specific section like biotechnology or the tech companies or the cybersecurity space, it's a lot less volatile. It's a lot more conservative, and you still experience growth. That's why I'm saying invest in ETFs. I mean, listen, if you really love Starbucks, if you really love Mickey Mouse, invest in Disney. I get it. It should be fun. So invest in individual companies if you feel strongly about it. But for most of you, I really want to focus on index investing. Even with all of this stuff, I have, investments in a lot of different companies individually. But still, to be honest, for the most part, the most money I've made has been in the index funds through ETFs that I've invested in myself. So I keep on talking about index investing, but I need to tell you what an index is. In the stock market, there are 4 main individual indexes. So the first index we are going to go over is the Dow Jones. Probably the most famous, the Dow. I'm sure a lot of you have heard of it. This index is comprised of 30 companies that have been around for a long time, and usually they pay out quite a handsome dividend yield, which is essentially a payment you receive as sort of a thank you for investing in their company. And you receive it quarterly, biannually, or annually. And it's just a small payment that you get from the company, especially if they do well in earnings, saying thank you for investing in our company and owning shares.
Thank you.
So for the Dow and the 30 companies that possess the Dow, I would say think of the Dow Jones Industrial Average as your old grandpa, waving high, saying, hey there, here's your quarter. Go buy a donut.
I don't want a donut, I want a sports car.
I like that. The second index is known as the S&P 500, or Standard & Poor's 500. This is the best representation of the market as a whole because it represents 500 large earning companies. Think of it as the middleman of it all. I invest in the S&P 500. It is the best metric I use to sort of predict where the market is headed next. So I would describe the S&P 500 as a pleasant guy waving hi. Your next door neighbor. He's just mowing his lawn. He's like, hey dude, and you're like, you're a class act. I like you. That's the S&P 500.
Hey Todd, can I borrow some butter? Todd, why are you mowing the lawn? It's 3 a.m.
How can you see with just one flashlight strapped to the front? Number 3 is the Nasdaq. Crazy name, right? It contains more than 3,000 stocks. A lot of the tech stocks, the sexy names like Amazon and Google, as well as the big biotechnology names. I would say that the Nasdaq is like a beautiful model blowing you a kiss. A gorgeous top 10 model, or like Fabio. And last but not least is the Russell 2000. This is a great index, and the main reason being is this index is comprised of a lot of young companies who are trying to enter the big leagues. So here's how this goes. A lot of these companies don't pay dividends. Why? Because they save all of their earnings and they spend the earnings on growth, trying to expand, trying to become one of the big boys.
You love to work it, don't you?
Yeah, I do.
So there's a bigger chance that some companies in the Russell 2000 will go from 0 to 60, in a couple of weeks instead of a couple of years. But you run the risk that their earnings may start to give out because they're such young companies. So the Russell 2000, high risk, but high reward.
And up and under.
I'm also invested in the Russell 2000. So think of it as a young boxer warming up, getting ready to get in the ring. Whew. So listen, I know I've thrown a lot at you, and I know it's a lot to take in. Long story short, this is where strategy comes into play, or your gut feeling, or an educated guess. What I would advise doing is kind of investing in each index, because here's the deal. A lot of people say if you want protection, if you want dividend yields, you want to invest in the Dow, because those companies have been around for a very long time. If you want to just follow the market as a whole, you usually want to invest in an index fund that follows the S&P 500. If you want to invest in tech and biotechnology, invest in the Nasdaq. Let's be honest, this year alone and last year, tech has led the way. I mean, Amazon, Google, Apple, those stocks have really carried the market. So if you invested in Nasdaq last year, that's outperformed. But how could you know? Nobody can predict the future. And the Russell 2000 has also had a great time because of the tax cuts. That has been great for the profit margins of young companies. So the Russell 2000 has also been better. These indexes fluctuate. They go up, they go down, they go sideways. Also to keep in mind, I invest in the S&P 500 index fund. It's called IVV. It's $278 a share right now. Remember what I said? If we want to do the 5% target, you're going to save $150. So do the math. You will need to save 2 months before you can buy 1 share of the S&P 500 index fund. And that's okay. There's absolutely nothing wrong with that, I promise. The Russell 2000 index fund that I'm in, remember the young boxer, IWM, that's in the 160s, the 170s, so maybe that's where you want to stick your money first. It's got to be a strategy, and it's proprietary to each person. So you need to decide for yourself. On my website, getmoneyright.org, I will put some examples down of index funds for the Dow, for the S&P 500, for the Nasdaq, and for the Russell 2000. Don't freak out. Long term, all of these indexes are going up because long term, all 4 of these indexes represent the health of the American economy. And you always want to bet for the American economy long term.